Hello, everyone. Adam Bergman here, tax attorney, founder of IRA Financial. On today's YouTube Live, 60,000 plus in tax deductions still available. Yes, still available. So hopefully you're watching this video and you haven't filed your tax return yet, whether it's April 15th or an extension. And there's still time to take advantage of the amazing benefits of the solo, the SEP IRA, and traditional Roth IRA. There's still opportunities up until April 15th, but for the solo K and SEP IRA, if you're self-employed, up until you file your return, including extension. So hope everyone's okay. This has been, I've had a crazy week, just an FYI. You see, I got my Air pods in. Like, it's been, I spilled coffee on my computer last week, so I had to get a new computer. Thankfully, everything's been backed up, but just having to get everything onto my new Mac. I'm sure you guys, hopefully, you haven't experienced something as traumatic as that, but it was a pretty tough few days. So this is the new look. Hopefully, the sound's okay. The audio. I'm always, a little bit worried about, but the video looks good. So, anyways, that was my week. So hopefully you never have to experience one of those miserable tech type weeks. But it's over. I'm better now. So let's have some fun with this. So I'm going to start and talk about eligibility for a solo K. Talk about some of the rules, and then we'll get into some of the tax strategies involved for generating some massive tax deductions for you. So who's eligible to set up a solo? Okay, so you need two things. You need to have a business, which could be selling a service, selling a widget. Doesn't have to be $1 billion business. Doesn't even have to have any income. There just needs to be the anticipation of profit. Okay, so even if you have zero revenue now, as long as it's not a hobby and there's the anticipation of profit, you're eligible to have a solo K. Second requirement, no full-time employees other than the owners, could be multiple owners, and their spouses. Full-time employee means 1,000 hours or more, 3 consecutive years of 500 hours or more. Okay, so independent contractors, consultants, someone works less than 1,000 hours, 3 consecutive years of 500 hours or less, or they're your spouse, they don't count as an employee and you're still eligible to set up a solo K. So what are the big advantages of a solo K? Well, for purposes of today's videos, it's the high contribution limit. For 2022, yes, we're still talking 22 because you still have time to make contributions for 22 in 2023. Again, the rules are going to get even better next year. But focusing on the 22 taxable year, the max you can put away, so long as you have sufficient income, is $61,000 if you're under 50, $67,500 if you're over 50. So there is the title of the video, 60,000 plus available tax deductions that are still on the table potentially for some of you. And that's my job as a tax attorney, to kind of explore some of these strategies and hopefully help you generate more deductions so you will reduce your tax liability. That's the name of the game. So let's break down how the solo 401k contribution rules work. There's two components, the employee deferral and the employer component. Start with the employee. $20,500 if you're under 50, or $27,000 if you're over 50 is the most you can put in to a solo K in 2022 from the employee deferral side. And you can do it generally in pre-tax or Roth. Obviously, if it's pre-tax, you get a tax deduction, right? Which is the premise of today's video. You can do Roth. There's no tax deduction, but the play with the Roth is so long as you're over 59 and a half, the Roth's been open at least 5 years, it's all tax-free, right? So you got to juggle current tax deduction, which accountants love, right? Makes their job easier and makes them look better when they reduce your taxable liability, versus a longer play game where you don't get that current tax deduction, but so long as you're over 59 and a half, the Roth's been open 5 years, all the distributions are tax free. So employee deferrals, 20,500 or 27,000. Okay. We're in 23. Can you still make those contributions for 22? Yes. If you're a sole proprietor, a single member LLC, you can still make the $20,500 or $27,000 contributions in 23 for the 22 taxable year. But you need to have a plan set up in 2022. Secure Act 2, which was passed in December 2022 signed by the president, starting for the 23 taxable year, so starting in 2024, you're going to be able to set up a solo K literally April 14th or October 14th, 2024 for the 23 taxable year and make employee deferral contributions. Today, for the 22 taxable year, you can only do the employer contributions if you set up a solo K in 23 and want to take advantage of the 22 taxable year. But if you have a solo 401k set up in 22 or before, then you still have time if you're a sole proprietor or a single member LLC to make employee deferrals and the employer contribution, which is 20% of your net Schedule C if you're a sole proprietor or single member LLC, and 25% of your W-2 if you are a CS Corp or partnership employee, up to an aggregate maximum for the 2022 taxable year of 61K or 67.5 if you're over 50. Okay. So let's break it down. Let's say you made $100,000 and you had a plan set up in 21 or 22. Okay. And you're watching this video and you're like, I've been procrastinating. I'm so lazy. Like, Adam, I get you. Let's do it. You have until your file your 1040. So whether it's April 15th or if you file an extension up to October 15th to make your contributions, employee and employer. Now, why are the rules different for a sole proprietor and a single member LLC versus a C, S Corp, or partnership? The answer makes sense. Why? Because if you are a net Schedule C, meaning you file your taxes for your business, your sole proprietor or your single member LLC on a Schedule C, which is literally an attachment to your 1040, there's no way you're going to know your net taxable income by 1231. You can't, right? Because there's all these expenses you got to tabulate. Maybe you have depreciation. Maybe you have other deductions that you're just not understanding or just not knowledgeable of, and you need to work with a tax accountant, CPA professional to help you out. And that doesn't happen before 1231. Why? People need to have time to look at all the income statements, profits and loss, balance sheets, all your bank statements, to make sure they have your net Schedule C. Then Social Security and FICA, so about 15%, is on the net Schedule C. And then that number after that is available for contributions. If you're under 50, 20,500. If you're over 50, 27,000. That's dollar for dollar. And then that 20% is on that net Schedule C. So let's say your net Schedule C is 100K, just for simplicity purposes. After deductions, after your self-employment and FICA taxes, you can do, if you're under 50, 20,500 for the 22 taxable year, up until you file your 1040 in 23 for the 22 taxable year, and then 20% of 100, giving you an aggregate of, let's say, 40,500. If you were over 50, you would be able to do 27,000, again, pre-tax or Roth, plus 20% of the 100, giving you 47,000. Now, if you made $1 million, you're going to be capped at the 61 or the 67.5 if you're over 50. You can't contribute more than you earn, and you can't go above the 61 or the 67.5. What happens if you only made 30K? Well, let's say the 30K is your net Schedule C after deductions, after self-employment, Social Security, FICA taxes, then you're not going to be able to deduct more than 30, right? You can do 20,500 and then let's say another 9,000 or so. Well, actually, it's going to be another 6. So 20% of 30 is 6. So you'll be able to put away about 26,500. Okay. So you take your employee deferral, your employer, you add them together. They cannot go above the 61 or 67.5. Employee deferrals can be pre-tax or Roth. Employer, the 20% or 25% if it's a W-2 is always pre-tax. And since we're talking about deductions, I'm going to kind of be focusing on pre-tax because that generates deductions. But just because I am a Roth lover and I actually do all my contributions in Roth, my accountant doesn't always appreciate that because he loses, the $60,000 plus in deductions that he can show me he's generating for me, which helps him justify his tax bill to me or his invoice to me. But there's something called the mega backdoor Roth. Okay, the mega backdoor Roth is a solution if you have a solo K. It's not going to work probably if you work at a large company. Why? Because there's something called a top heavy test, and generally what happens is not enough rank and file employees end up doing the mega backdoor. Only some of the highly comps do, or the executives, and it tilts the plan and it makes it fail the top heavy test based off contribution. So for solos, there's no RISA, right? There's no top heavy test because it's only you or a spouse or another owner. So the way the mega backdoor works, which you can do up until you file your return, whether it's April 15th, October 15th, or your company return, whether it's March 15th or September 15th, if you're a partnership or S Corp, the mega backdoor allows you to go dollar for 2022, 61K or 67.5. Now, the beauty of the mega backdoor is you actually can set up the plan in 23 to do the mega backdoor for 22. You still got time. In fact, you have time up until you file your return, including the extension. So if you're watching this and you're like, deductions, whatever, I'd rather do Roth. Well, hey, light bulb should go off now and say, hey, I can set up a solo plan now in 23 and then dump in an extra 61K or 67.5 if I'm over 50, so long as I have enough income in my business, all Roth. And then you can leave it in the 401k, or you can actually just move it to a Roth IRA. And now imagine you do that for the next couple of years, 60K plus in Roth every year. Yeah, do the math in your head. I mean, it's monster, massive amounts of money that so long as you're over 59 and a half and the Roths open at least 5 years, it's all tax-free. So it's a massive, massive tax strategy. So the beauty of where we are today is thanks to Secure Act 1, you can set up a solo K in 23 before you file your return. For the 22 year, you are limited to either the mega backdoor Roth or the 20% or 25% of your W-2 up to the 61 or 67.5. Employee deferrals for the 22 year cannot be done in 23 if you have not set up a plan in 22 or before. If you have set up a plan in 22 or before, don't worry. You can do your employee deferrals for your sole proprietor or your single member LLC up until you file your return plus extension. If you're a W-2 through a C or S Corp or get a guaranteed payment from a partnership, your employee deferrals have to be done by 12/31, but your profit sharing, the employer side, can always be done until the company files its return. So again, what's the difference between the sole proprietor? Why are the rules different for sole proprietors and single member LLCs versus W-2s? It's basically what I said. If you have a W-2, you know what you make, right? You know your W-2, whether it's September, April, or November, you know what your salary is. It could change, there's bonus, but you kind of know what your W-2 is, okay? Whereas if you're a net schedule C or sole prop or a single member LLC, you generally don't know what your net amount is till probably February, March, April. So the IRS does give you time, which is, definitely something we all appreciate, and really just it's a necessity because there's no way that a sole proprietor or single member LLC would be able to figure out what their contribution amount should be by 12/31. It's an impossibility. So that's why the rules are more flexible for sole props or single member LLCs. But bottom line, okay, we're sitting in April 23. Wake up. There's time. If you have a solo K, you can still do employee deferrals for your sole proprietor or single member LLC business until you file your return plus extension. If you were a W-2, don't sweat it. You can still do the 25% of your comp up until you file your company return, including extension. If you are a Roth lover like me, the mega backdoor, which would go 61K or 67.5, all in Roth, dollar for dollar. That means that let's say you're self-employed, you made 70K, and you have other income. It's like a side gig. You're a pretty successful person, and you'd rather put that money in a Roth to save it versus just blow it on snowmobiles and sushi. Then the mega backdoor is an amazing solution because you can literally dump money in tax-free. You don't get the deduction, but that money is going to grow without tax. And so long as you're over 59 and a half, the Roth could open 5 years. It's all tax-free when you pull it out. You can also borrow against it up 50K or 50% of your account value, whatever's less. So you have some opportunities. And if you have a self-directed solo K, you can do traditional as well as alternative assets like real estate or crypto. So you get to invest it the way you want. It grows without tax. You can borrow against it. And once you're 59 and a half, the Roth's been open 5 years, voila, it's all tax free. So that is the smart way to save. Now, on the flip side, if you want your deductions because your accountant's hounding you to reduce your tax liability, also cool. If you haven't set up your solo K, that's okay. And you want to take advantage of deductions for 22, I can still get you the 20% of your net schedule C for the 22 taxable year in 23. If you have a solo K set up in 22 or before, you got time until April 15th or when you file your final return with extension. So whether it's October 15th or September 15th or July 15th, you have time. So this video is just like a wake-up call to say, hey, yeah, we're in 23, the 22 taxable year is gone, but it's not too late. And that includes IRAs. If you just want to put money in an IRA, 6,000, 7,000, if you're over 50 for 22, you can still do it by April 15th. Now, if you earn too much money because you have access to a 401k at work, and you have more than about 125,000 married filed jointly, you'll do a Roth. Now, even if you make $1 million, you can still do what's called a backdoor Roth IRA, right? Roth IRAs have income limitations, 214,000 for 22 married filed jointly. Even if you make $1 million, you just do what's called a backdoor Roth. You make contributions to an after-tax IRA and then convert it to Roth. So that's your workaround. So let me summarize all this because I kind of dove through and explored contribution options and tax solutions, relatively quickly. I know you guys are busy. It's, Good Friday's coming. People have long vacations planned, holiday weekend. I don't want to keep you guys too long, but I do need to give you all the answers. So let's recap. If you have a solo 401k set up, 22 or before, sole proprietor or single member LLC, you can do employee deferrals and employer, the 20% of your net schedule C, up until you file your return plus extension. If you are a C or S corp, you have to do the employee deferrals. Technically should have been done by 12/31, but the 25% can still be done until your business files its return plus extension. If you've not set up a solo K in 22 or before, and you want to, because you're watching this video and you're like, hey, there's still potential opportunities for me. The way the rules work today is that you can only do the employer contribution, which is 20% of your net schedule C, if you're a sole proprietor or single member LLC, or 25% of your W-2 for the 22 taxable year, up into 61K if you're under 50, 67.5 if you're over 50. Employer contributions are pre-tax. You do get a tax deduction, and you can always convert to Roth. Mega backdoor. So you're listening, watching, you're like, holy cow, I can go 61K all the way to Roth or 67.5 all the way to Roth. Bingo, I'm doing it. That plan can be set up until you file your return. You do not need to set up the plan or did not need to have set up the plan in 22 for the mega backdoor. You can set it up in 23 so long as it's a day before you file your return plus extension. So that is a huge, huge opportunity that still awaits us. And don't worry, I'll still continue to do more videos and podcasts on that mega backdoor because it's out there. It's a great strategy that just people don't know about. And hopefully more and more I pound it into your head, you're going to realize if you are eligible and have a solo K and are a Roth lover, that it's literally the Mount Everest of Roth strategies, right? A Roth IRA, you can only put away 6 or 7K, 6,500, 7,500, and 23. Mega backdoor for 22, you can go 61 or 67.5 dollar for dollar. In 23, you can go 66, 73.5 dollar for dollar. So it's monstrous, right? It's just unfortunate that so many people just don't know about it. So the SEP IRA, I just mentioned it briefly. It's a poor man's solo K because it's only a profit sharing plan, right? But thanks to Secure Act 1, before 2019 or before 2020, once 12/31 passed and you didn't have a solo K, you were out of luck for the previous year. Secure Act 1 basically said, no, you can do employer contributions for the previous year. That is what the SEP IRA rule is. So you're not going to get any value by doing the SEP or the solo. The solo is a better plan because it has a loan feature. There's Roth options. And even though the SEP currently has Roth options going forward, it doesn't for prior years like 22. And it has a super advantage if you are a real estate investor and want to use leverage. You can use a non-recourse loan without triggering the UBIT tax, which doesn't apply to SEP. So ultimately, the solo's here, the SEP's here, and then the IRA and Roth are below it. But even if you make 300-400K and you're just like, I want to add another 6K into a Roth, you can do it. Even if you max out the 61 or the 67.5 in a solo, you can also do the Roth IRA, which will give you another 6 or 7K. Just if the money's lying around, you don't really need it, you might as well save it in a Roth because it's going to grow tax-free. So long as you're 59.5, the Roth's been open 5 years, it's all tax-free. Okay, so that's the play. That's what you need to know. So it's a lot of info. I get it. But two things to take away from this is this. Number one, if you haven't set up a solo K for 22, it's not too late, right? You either can get you're generally going to get the employer contributions. Starting in 24, you're going to be able to get employee and employer contributions for sole props and single member LLCs. W-2 taxpayers, C or S, or guaranteed payments through partnership, it's always just going to be profit sharing. Why? Because the employee deferrals always have to be done by 12/31. But still, 25% of 100K is still 25K, right? 25% of 50K is money, right? It's 12,500. So it's deductions. They're available. It may not be the 60K plus, but 5, 10, 10K, 15K. It all adds up to reduce your taxable income. And you get two benefits. You reduce taxable income, and that money gets to be invested through a tax advantage retirement account and doesn't pay tax on its income or gains, which means it takes advantage of the power of deferral, power of compounding returns. Average an 8% rate of return, your money should double every 8 years. That's it. Okay, so I hope you guys enjoyed today's video. It's super important. It's understandable that people kind of procrastinate. I'm the same way. And then 23 hits and they're like, oh man, I forgot to set up my plan for 22. I'm out of luck. I'm so stupid. No. I'm here to say, no, you're not out of luck. The government gets you. They know you're business owners. You're busy. You got to pay bills. You're just trying to survive, trying to grow. You're not so focused on retirement accounts. I am, right? Because that's my background. That's my passion. So that's my job to help educate all of you so you can be better retirement savers, better self-directed investors, and ultimately richer when you retire. That's the name of the game. And it works. The system's literally rigged in our favor. Why? Because we get benefits. We get tax deductions for pre-tax. We get to have our money grow without tax in the retirement account, which is deferral. That's the double benefit. Now, if you do a Roth, the benefit is greater on the back end because it's tax-free so long as you're 59.5. The Roth's been open 5 years. You don't get the tax deduction currently. Whereas the pre-tax, you'll get the deduction and the deferral. But when you pull the money out, it's subject to tax after the age of 59.5. In the case of the Roth, no tax deduction, but once the Roth's been open 5 years, over 59.5, it's all tax free. So don't be down. Tax time is coming, but if you file an extension like I do and like most of my family and colleagues do, it's okay. You still can potentially set up a solo K for 23 and at least get that 20% of your net Schedule C or the 25%. Plus, you have that plan for future years and you can start making contributions for 23 and beyond. Going forward in 24, it's going to be even easier because you're going to be able to set up a plan in 24 for the 23 year. And if you're a sole proprietor or single member LLC, you'll be able to do employee deferrals and profit sharing in 24 for the 23 taxable year. And if you're a Roth lover, think, and definitely check out videos and podcasts and tons of blogs I've done on the Mega Backdoor. It's the ultimate Roth solution. Don't worry, I will be doing multiple videos in the future about the Mega Backdoor. I've done them in the past, but I'll keep them up because sometimes people just doesn't hit them how amazing it is, and people are just like, wait, is that legit. Like I can go up to 60K or 67.5 in a Roth and then just put in a Roth IRA. Like, holy cow. Yeah, you could. It's true. So the frustrating part is there's so many more people out there that should be doing it. You're not going to be able to do it if you get a free plan at like Vanguard. They're not going to have that option. IRA Financial's plan has it. So it's really the ultimate raw solution. But if you're looking for tax deductions, hopefully this video has explored some tax strategies you can employ, whether it's the traditional IRA, if you have low enough income and have access to a 401k, and the solo K from either the profit sharing employer contribution, or if you have the plan set up prior to 23, also the employee deferral side for the sole proprietor. Single member LLC. Otherwise, thank you guys for watching. Appreciate it. Hope you guys enjoyed the video. I want to wish everyone a happy holiday. And I'll see everyone again next week. Ciao. Take care. Have a great day.